Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks pairing session losses as Japanese indices turn positive. Volatility is still gripping markets, with investors evaluating policy, geopolitical, and recession risks. Oil holds on to gains as markets are in wait-and-watch mode over a possible strike by Iran on Israel in retaliation for assassinations of Hamas and Hezbollah leaders. Plus, two key interviews this morning. We speak to the CEO of Johannesburg Stock Exchange as it tries to attract listings, and the CFO of Adnoc Logistics and Services amid earnings and global expansion push. Well, it's just gone 8 a.m. across the Emirates. I'm Giovanna Bercecci in Dubai. Let's get you caught up on how these markets are faring and what has been quite a turbulent ride for the stock market indices so far. But as you can see, we are inching towards the green as we head into the U.S. session. The close for Wall Street was negative. We had a 10-year auction that didn't go quite very well. And so on the back of that, 10-year yields were up about 5 basis points on the session. Today, continuing on with some of the moves, though, some stabilization coming through. We're about 3 basis points lower, but broadly speaking, we're up about 20 basis points on the week as a whole. Some green coming through on the Asian session as well, so that's translating to better price action for U.S. equities. And then keeping a close eye on Brent, today sitting at 78.61. So we have come a couple of dollars higher in the last couple of trading sessions as some support came through as we approach the $75 level. We're going to talk more about some of the drivers of oil throughout the course of the show. Switching over, though, our terminal chart today is just highlighting some of the volatility that has come through in cross assets this week. And yes, even though we have come back from some of those extreme levels we got to Monday, Tuesday, what we are seeing is that cross-asset vol is still sitting at very high levels relative to where they were, say, just a couple of months ago. So it has still been quite a volatile week for all of these different asset classes. You talk about commodities, FX, equities, of course, and all of that is reflected in the charts there. So we've come off, but volatility is still at high levels. Let's check in also on how these markets in Asia are faring. Avril is in our Singapore studio standing by. Avril, what has been on your radar today?
Well, it's the volatility in Asian markets, particularly in Japan. For a second session, we're seeing equities there flipping from losses to gains as the session progressed. But now you can see Nikkei topics back in negative territory. Part of the problem is the confusing messaging we've been getting from the BOJ in the past week. Today, we got the summary of opinions from its July meeting. One board member says that the neutral rate seems closer to the 1% level. We are far from that now, at around the 0.25%. We also saw the driver in terms of that weak demand for U.S. treasuries, and that is, I think, reflected in a way in the expectations of what we were going to get for a 30-year auction out of Japan today. Weak demand was expected. Instead, it was pretty decent. So you're seeing that showing up in Japanese bonds. In terms of the yen, we're seeing it pulling away from the 147.7 that it hit yesterday, sparked by Deputy Governor Uchida's comments. This is what we're seeing cross assets in Japan. It's pretty mixed in the rest of the region. Jumana.
Yeah, it continues to be volatile. We were just talking about volatility across different assets. Avril, thank you so much. Now, Asian equities have been going back and forth between losses and gains on Thursday, continuing a bout of roller coaster trading as investors digest signals from central banks. New York Fed President and Bloomberg opinion columnist Bill Dudley forecasts ongoing volatility as traders navigate market uncertainties.
When market sentiment deteriorates, that can be self-reinforcing. People start to pull back on hiring. People pull back on spending. Next thing you know, the unemployment rate hasn't gone up 0.5%; it's gone up a full percentage point or two percentage point. You're in a recession.
Meanwhile, economist Nouriel Roubini told Bloomberg exclusively that the market is getting too pessimistic in its pricing in of Fed rate cuts.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
Nouriel Roubini there, sounding uncharacteristically optimistic. Joining me now is Katrina, Director of Economic Research at Moody's Analytics. Katrina, good to speak with you. Maybe I'll just start with some of those comments from Nouriel Roubini suggesting that markets and investors may have got ahead of themselves in terms of expecting a recession or a hard landing. Are you of the same view as well?
I mean, our expectation has been for quite some time that the US economy will comfortably avoid a recession, a hard landing, however we want to label it. I think what was interesting coming out of the July employment report as a nice starting point would be the fact that, sure, it certainly surprised on the downside with the amount of jobs created. We did see that uptick in the unemployment rate. But if we look deeper at the details of what's actually going on, it wasn't a sign of weakness. We actually saw some decent jobs still being created. That labor supply is continuing to expand, which is contributing to that higher unemployment rate. I mean, sure, demand has pulled back, but it hasn't pulled back materially. So I think when we're looking at how the US economy is going with digesting these restrictive monetary policy settings, we need to keep a close eye on what's actually happening with the labor market data and not just look at those headline figures, but actually look at the underlying driver. I think that's going to remain critical going forward.
Yeah, that was going to lead me to my next question, which is if you look at those labor market figures, and of course we had one surprising figure to the downside, but that is probably not the start of a new trend, because many people are saying that you have to look at the immigration numbers, and the reason why the unemployment rate has been ticking up higher is because there's a much larger worker pool. So how much of that is going to be just a one-off feature versus a trend to look at in the coming months?
Yeah, it's a really good question. So basically that labor supply is going to continue to expand, which we will see the unemployment rate tick higher as a result of that. So when we're looking at what's actually going on with the labor market and whether we are going down a much weaker trajectory, that would kind of send alarm bells on the recession side of things. We need to look at what's happening with the unemployment benefit claims. So if we see that labor demand has pulled back significantly and we do see claims for, unemployment insurance tick up materially, that's when we need to get concerned. But we're not at that point yet where we need to get concerned. I mean, overall, the US consumer is still in a healthy position. And overall, the US economy has just proven so much more resilient to rate hikes than what we could envision. But I think one point to bring up, which I think is kind of getting overlooked in markets, is that just as the US economy has proven resilient on the way up, it's also going to not be as sensitive to aggressive rate cuts if we do so need those.
Interesting. Yeah. And also on the jobless claims front, we'll be watching out for those figures later today. Let me just take you to all of the price action that we've seen in Japan in the last couple of weeks. There's a saying, there are decades where nothing happens and then weeks where decades happen. And I think that's really encapsulated some of the price action in Japan. To your mind, do you think that given the volatility as of late, the Bank of Japan are going to struggle to push through further interest rate hikes?
Oh my goodness, it's an awful time, I think, to be at the Bank of Japan right now, because they are between a rock and a hard place. I mean, they have been quite clear to some degree of the fact that they do want to move forward with rate hikes. They do want to withdraw this ultra accommodative monetary policy, but at the same time, you've got the real economy, which just doesn't support that rate hike view. Households are in a weak position. Growth isn't doing well. I mean, our forecast for Japan's GDP growth this year is for a 0.3% contraction. That's not the kind of growth or lack thereof that you really want to be withdrawing monetary stimulus. So I think it's going to be incredibly difficult. And I think markets aren't going to be kind to the Bank of Japan as they do kind of push forward with these glacial hikes.
Yeah, so interesting what you have to say about the economic outlook and also the inflation outlook there as well. I just want to quickly round up, of course, with the other major economy in the region, and that is China. A lot of downward signals have come through reflecting just the broader slowdown there. And even though authorities have come in to try to shore up the economy, how effective are they actually going to be?
I mean, at this point, we're not too optimistic on the effectiveness of the policy measures that have been announced, where they're particularly focusing on the consumer. We're not seeing that the consumers are getting the direct support that they need to actually lift household sentiment. Household sentiment has been incredibly weak post-COVID, it hasn't recovered like it has in other markets. So they need to be, providing that assurance to actually get out there and spend. What's going to do that? It's going to be improving the labor market. It's also going to be improving social security, that kind of thing. And we're not seeing that direct support coming to households, unfortunately. So unfortunately, it means that the domestic demand picture in China is probably going to remain weak throughout this year.
Katrina, great to have you on. Thank you for bringing your insights to our show. Katrina Al, Director of Economic Research at Moody's Analytics. Now, also coming up, we have two standout interviews. We'll be speaking to the CEO of Johannesburg Stock Exchange as it grapples with the country's economic environment. And the CFO of Adnoc Logistics and Services joins us amid its growth strategy. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersachi in Dubai. Libya's Prosecutor General has ordered the arrest of the country's oil minister, though it remains unclear who currently holds this post amid the ongoing political upheaval in the OPEC member nation. The unnamed minister, along with his office director, are being accused of behavior that is inconsistent with their job duties. The move adds to the uncertainty in the industry, with oil production frequently impacted by struggles between dueling administrations in Tripoli and the East. But oil is steady after its biggest advance in a week, with the market on edge over a possible retaliatory strike by Iran on Israel. That is, of course, after the assassinations of top Hamas and Hezbollah leaders last week. Brent futures traded near $79 a barrel after rising 2.4% on Wednesday, while WTI was above $75. So for more on this, Andrew Janes, Bloomberg's energy and commodities editor in Singapore, joins us right now. Andrew, talk us through some of the price action this week. Brent got very close to $75, saw a bit of a bounce, and it felt as though it was caught in the crosshairs of all of this cross-market volatility, but has finally gained some support.
That's right, Jumana. It was earlier in the week, it was pulled down a bit by the global equities rout, but it's recovered since then. Big jump yesterday, and that was partially due to what you mentioned about Libya. The Sharara field, which is the biggest field there, is offline, and the authorities there have declared force majeure. That's about 270,000 barrels a day of oil that's offline. That may seem small compared to 104 million barrels a day, which is global consumption, but it is enough to move the needle. We're also, of course, waiting for this potential retaliatory strike by Iran. We've been waiting for a week. It does look like Iran is seeking to de-escalate the situation. It's still likely it will retaliate because it wants to set some sort of red line for Israel, but I think it's very mindful that it doesn't want this to sort of expand into a wider conflict.
Yeah. So let me just pick up on some of the drivers of oil as well. Yeah, let me just pick up on some of the drivers of oil as well. One of the major concerns as we head into Q4 is the sheer amount of non-OPEC supply that's going to be hitting the market. And the question for investors is whether OPEC can actually start putting their own barrels back into the market that already seems to be quite well supplied.
Yeah, well, the current plan is for OPEC plus to start restoring barrels from October. The macro picture does seem to be worsening. There's no sort of sense that demand will improve in China. US demand has actually been pretty good, but that will tail off at the end of the summer as it does seasonally. You also have these predictions now, increased predictions for a recession in the US, which could affect things there. I mean, it was only a few months ago OPEC was trying to aim for a $100 oil price. According to Javier Blas, our Bloomberg Opinion energy columnist, they're going to have trouble defending 75 now.
Yeah, something to watch out for, no doubt. But at least at these levels, we have rebounded off the 75 mark. Andrew Janes, thank you very much for joining us, Bloomberg's energy and commodities editor in Singapore. Now for a look at some of the other stories we're following today. Thousands of anti-racism protesters have turned out in towns and cities across the UK to counter the far-right demonstrations. Meanwhile, many of the UK's biggest banks and consultancies are encouraging staff to go home early this week as far-right groups planned more anti-immigration protests. Police were set to deploy thousands of officers across Britain after rallies in the past week turned violent. The unrest is being fueled by an online misinformation campaign following the murder of 3 young girls in northwest England. Taylor Swift's 3 scheduled concerts in Vienna this week have been cancelled over what Austrian police say is a suspected terrorist plot. 2 people have been arrested, including a 19-year-old Austrian allegedly radicalized by the so-called Islamic State group. Security officials say chemical substances were found at the teenager's home, and Swift's Eras tour is due to wrap up in London later this month. Thailand faces fresh political turmoil after its top court ordered the largest opposition party to disband for violating election rules by promising to amend royal defamation laws. The court also banned the Move Forward party's leaders from political activities for the next decade. The same court is set to rule next week on a petition to oust the Prime Minister, Srettha Thavisin, over an alleged ethical violation. Now, coming up, Novo Nordisk plunges after cutting its profit forecast for the year as its blockbuster weight loss drug Wegovy misses. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Europe's most valuable company, Novo Nordisk shares, dropped the most in 2 years after disappointing sales of its weight loss treatment, Wegovy. Revenue from the drug was hit by higher than expected price concessions in the competitive U.S. market.
The second quarter is a quarter where Wegovy came in a bit short of consensus, and that's linked partly to some adjustments in how we accrue for rebates. So we really urge investors to not just look at the quarter in isolation, but look at our confidence in the rest of the year and the upgrade we are bringing.
Well, let's bring in senior biotech analyst Mikey Shah from Bloomberg Intelligence, who joins us from London. Mikey, it's great to have you with us. So the stock was down almost 7% yesterday. Was the reaction warranted, to your mind?
I mean, when we look at Novo's valuation relative to peers, it's trading at a premium, so P of 38, mean for large pharma peer groups about 18. So it really has little margin for error. In terms of their 2Q delivery, I have to say it wasn't the cleanest quarter, but nothing to get too scared about. A slight underperformance on sales. Insulin outperformed. They offset the misses for the two key growth drivers, Ozempic and Wegovy. And then we saw an earnings miss that was underpinned by a known R&D charge. So that also led to, a guidance cut on operating profit. But when we adjust for that R&D charge, we saw an underlying upgrade on operating profit as well as sales. And when we look at the GLP-1 volume, so Wegovy and Ozempic, supply is obviously a bit of a constraining factor at the moment. We see strengthening volume. So all of that is encouraging, and we believe that Novo can deliver at least the top end, of their guide this year.
Yeah, Mikey, one of the elements that popped out to me yesterday from the earnings is that as Novo is getting more access into the U.S., they're being forced into discounting via quite a complex system of rebates with the pharmaceuticals, so with the insurers, I should say. So how is that likely to impact coming quarters and their ability to actually continue gaining market share within the U.S.?
I mean, I think that's just part and parcel of the space, to be honest. We've seen that in diabetes. So we've seen rebate increases, up to the 80% level on an implied basis. We're going to see fluctuations or a bit of volatility in terms of these rebate adjustments from quarter on quarter. I think it's probably better to look at the implied rebate over, a year period. But, with that price discount, you'll probably get increased volumes. So that should more than outweigh the pressure on price there.
Yeah. And one of the big issues for these weight loss drugs is actually creating the supply to match demand. And I know that Eli Lilly has mentioned that they're struggling to produce enough quantities of their drug. How is that expected to feature when you look at the outlook again in the coming quarters? Is supply going to be an issue?
I mean, both Novo and Lilly, are investing heavily in, expanding their capacity. It's going to be a gating factor, at least over, the near to midterm. But, we should see some of that, those supply constraints ease or, supply into the market improve over the long term. So, as I said, both are investing to expand capacity. We should also see kind of oral GLP-1 launch in 2026, 2027 timeframe. That should alleviate some of the supply burden, given that they're smaller molecules, they're not peptides, they're easier to manufacture, generally speaking. And then we'll also have more players come to the market as well.
Yeah. It's just incredible to witness how far Novo Nordisk has come just in the last year, and it's by far the biggest European company by market cap now. To what extent do you think the weight loss landscape, the obesity disease landscape, is fully priced in to where these stocks are trading now? Are we fully discounting the potential of where these drugs can go?
I mean, if we look bigger picture, I would say the obesity market is still very much in its infancy. So, treatment rates are relatively low, so penetration in low single digits. When you look at the addressable population and obesity prevalence at the moment, more than 1 billion people could have obesity by 2030. So when we look at, how big this market can get, I mean, we put out a conservative figure of, 93 billion plus market in 2030. Novo's got about 40% of that. Lilly's got about 50% of that. But, we also see upside there on kind of lengthening treatment durations, and also the potential for new treatments and new modalities coming in as well. So I still think there's, significant runway for both Novo and Lilly in this space.
Yeah. Mikey, great to have you on. Mikey Shah from Bloomberg Intelligence talking us through some of the price action in Novo Nordisk yesterday. Now, for a look at some of the other stories we're following today, Warner Bros. Discovery shares tumbled in late trading after second quarter results that missed expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. The firm has concluded that cable channels are no longer worth what they were in 2022 when Discovery acquired Warner Media. Now, a quick look at futures as we head to the break. Another volatile session, but right now we are leaning towards the green. We're going to talk more after the break. Speaking to Leila Fourie, the Johannesburg Stock Exchange CEO, following the bourse's latest earnings. Next, this is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks pairing session losses as Japanese indices turn positive. Volatility is still gripping markets, with investors evaluating policy, geopolitical, and recession risks. Oil holds on to gains as markets are in wait-and-watch mode over a possible strike by Iran on Israel in retaliation for assassinations of Hamas and Hezbollah leaders. Plus, two key interviews this morning. We speak to the CEO of Johannesburg Stock Exchange as it tries to attract listings, and the CFO of Adnoc Logistics and Services amid earnings and a global expansion push. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Versace over here in Dubai, getting you up to speed on how some of these markets are faring. It has been quite a volatile session for these futures. We were negative, then we slipped to positive, and now we're back to negative again. As you can see, the S&P futures lower to the tune of about 4 basis points in tandem with the price action that we're witnessing in Asia. It's also been quite a volatile ride for the Nikkei, which was negative, then positive, and now flipping back to negative again. So volatility coming through. Nasdaq futures seen a little bit positive after the down session yesterday. yesterday. 10-year yields in focus were about 3 basis points lower. All eyes yesterday on that auction that came in weak relative to the levels it went in. And on the back of that, we saw yields move higher to the tune of about 5 basis points today, regaining a lot of that ground. And then Brent sitting at around $78. As we were talking about, some stability has come through the last 2 days. We saw the oil complex jump more than 2% yesterday in trading. As for our terminal chart today, well, the theme of this week has been volatility, volatility, volatility. What you are seeing is that cross-asset volatility has pulled back from some of the highs we got to on Monday and Tuesday, but still at relatively high levels versus where we were a couple of months ago. So that is the volatility on FX, and you're looking at stock market equity indices as well, coming off, but still at relatively high levels. Now, shares in the Johannesburg Stock Exchange closed lower after first half results. Africa's biggest bourse reported net income that missed estimates as the operator grapples with a challenging economic environment. Joining me now is Leila Fourie, the Johannesburg Stock Exchange CEO. Wonderful to have you with us. Thank you so much for joining our show today. What I do see is, despite the stock price reaction, revenue was actually still up year on year, though we did see some double-digit declines, say, in equity trading. So how would you describe the quarter in your own words?
Johanna, thank you very much. And our operating environment has been characterized by a significant shift in sentiment. Although we started off very low and ended up 12% down on our equity value traded, we delivered a stable financial result with NPAT being flat. Despite the lower value traded, our revenue rose 4.2%, which was supported by growth of 29% in our investor services business, a 25% jump in commodities trading, and a 17% growth in our co-location infrastructure. Our business is cash generative. Our cash grew by 3%, and it's really underpinned on an ongoing focus on revenue diversification.
I was looking at the numbers for this year. Foreigners have been net sellers to the tune of 82 billion rand of South African equities this year. The last time that they were net buyers was all the way back in 2015. What do you think needs to change to lure the foreigners back into these equity markets again?
Well, Johanna, we have seen a shift in sentiment. And yes, our equities market is down, but the bond market is up on an all-time high, 49 billion positive net inflows year to date, which is the best inflow that we've seen since the beginning, since 2020. Now, if you have a look at the Aussie performance, since the announcement of the Government of National Unity, there has been a remarkable shift in sentiment. We've seen year to date our all-share index returning 3.3%, which is outperforming the MSCI index, which is only 2.3% up. Even on Monday's rout, you could see the Aussie posting a 1.19% down versus the emerging market MSCI index, which was down 4.22%. So we are starting to see the green shoots of reinvestment into the country, and that's really off the back of political certainty, a more centrist and more government-friendly government that's been appointed last month.
Yeah. Well, back in March, you told us that you were expecting to see 10 listings throughout the course of this year. And I wonder, since the election results and since the formation of the National Unity Government, whether that outlook still holds and whether you see scope for further listings.
We are looking a lot more positive on the listings front. We've seen 4 listings to date. Canal Plus, which is decoupling from Vivendi, will be listing on the London Stock Exchange and plans to secondary list on JSE. Coca-Cola is still in the market for a listing, but waiting for the right time. And we have a number of other listing potentials. What is particularly interesting in our primary markets is the amount of secondary capital that's been raised. Last year, this time, we had raised 4 billion rand, and this year we've raised 70 28 billion rand. So a big jump in secondary capital raise.
Have you seen any notable impact this week specifically on the stock market, given all of the global stock market volatility, the unwind of some of these EM carry trades, so to speak?
Yes, South Africa has behaved slightly differently to the rest of the emerging markets. As I said earlier, we outperformed on the equity side. On the carry market side, our bond market has been buoyant. We've returned better returns than similar countries with similar credit ratings. And so we're seeing our bond market being a little bit more favored than some of the other emerging markets. And the yields are very strong relative to the underlying credit risk.
Well, Leila, I'd like to end the interview asking you a question that I think is close to your heart. I know that Friday is Women's Day in South Africa. What are you doing to mark the event and also to help encourage women to enter into the finance profession?
Indeed, at the JSE, we do very strongly support equality and women's rights. And this year, we will be continuing to hold our She Invests conference, which will be held on Saturday, the 17th of August from 9:30 a.m. And really, this conference is all about empowering women, financial literacy, and building independence and investment confidence in the South African community. It's a very exciting program and very, very well oversubscribed, in fact. And we see a great hunger for knowledge by the women on the ground in South Africa.
Yeah, I'm sure. Leila, thank you so much. Leila Fourie, Johannesburg Stock Exchange CEO, joining us today to talk about earnings and more. Well, as we were speaking, I just want to bring you a monetary policy decision that we got out of the RBI. So in line with most economists, not Bloomberg Intelligence, but most economists, RBI has left key rates at 6.5%. So in line with estimates of 6.5%, the governor is saying it was a 4-2 vote for the stance decision. So there was a little bit of a split on the committee. RBI will stay focused on the withdrawal of accommodation. And they are saying that ultimately growth remains strong. India's growth remains strong, and that is the reason why they are holding rates where they are right now. So some in the market had thought maybe they would opt for an interest rate cut, but at this point it seems like the inflation outlook is not yet one that would tally up with them introducing rate cuts just yet. So India's RBI has left the key rate at 6.5%. Let's take a closer look at how Indian assets have fared in response to this interest rate decision. Avril, run us through it.
Yeah, the market's expectation was for no change, but I think those comments about how inflation remain sticky, stubborn, food inflation in particular, slightly less hawkish than some might have expected. And perhaps a reason for why the RBI left things unchanged is also because of the weakness we've been seeing in the currency, the rupee, approaching fresh record lows. The 84 handle is what we're watching. And this has got to do with some of this equity market outflow as well as the unwind of the carry trade. Today, we're seeing as the RBI decision came through and we're hearing its statement, what the RBI governor had to say, extending declines. Now, we are only about 0.3% down on the Nifty, on the Sensex. So steeper declines in the stock markets. Also watching what we're seeing in the bond space as those declines on India bonds also pick up a fair bit. Joanna.
Yep, it seems to be risk off once again. Avril, thank you so much for the analysis post that RBI decision. So keeping interest rates steady, but then also saying that global inflation is receding grudgingly across economies. That's just commentary that's coming through now from the RBI governor. All right, also coming up, Adnoc Logistics and Services reports its second quarter results. We speak to the unit's CFO on how the company is planning to expand its global energy business. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersetchi in Dubai. Adnoc Logistics and Services reported a second quarter profit of $207 million. The unit of the UAE's biggest oil company says its strong financial growth will accelerate its expansion strategy. Adnoc L&S recently agreed to acquire majority stake in maritime firm Navigate, in a move that will push Adnoc L&S's international reach. So for more on this, Nicholas Gleeson, Adnoc L&S CFO, joins me right now. Nicholas, let's just start with the earnings. It seems to be a really strong quarter. Revenue up 42% year-on-year, profit up 28% year-on-year. What's driving the gains?
So it's what we promised at the time we IPO'd, and thanks for having me on, Joanna. Essentially, when we listed, we said to the market that we had a long string of acquisition and growth opportunities, and some of those we've executed, some of those we've committed to. We've done really well in the integrated logistics segment with continued growth in the business. Jack-up barges are moving greatly. The investment that we made in Zacha Marine is performing extremely well. We've done extremely well also in the non-ILSP business, going beyond our core business with Adnoc. And in shipping, the tanker rates have been great, and we've done really well in dry bulk as well. So across the business, things are growing as we promised at the time of IPO.
Yeah, so let's talk about some of those deals. You have recently signed a deal with Navigate, as I was just highlighting. Will pay $1 billion for 80% of the company. Will require the remaining 20% in 2027. Talk to me about how a deal like this is additive to your strategy and how it further bolsters your growth plans.
So we're thrilled with this deal. This is exactly what we were looking to do at the time of IPO. We spent a lot of time planning for this and finding the right partners. Great leadership, great people globally. They've got 15 offices covering 5 continents around the world. This gives us a platform to expand our shipping reach, not only in terms of commercial reach, but commercial operations, ship management globally. So while we were doing really well operating out of the UAE, we now have offices around the world to extend our shipping capabilities globally. And as you can see, we're growing our shipping fleet very, very fast to match that. They also have a fleet of 28 modern tankers plus 4 medium-range new-build tankers coming. So it's a great complement to our existing tankers fleet.
Yeah. I believe the last time we spoke, you mentioned a $5 billion number you'd set aside for acquisitions. So this is $1 billion. I just wonder how much is left of that. Where are we sitting on that number?
So we've committed more than that already since the day that we announced the $5 billion. And in fact, we still continue to grow beyond that. So $1 billion, which will ultimately be $1.5 billion on Navigate by the time we buy out the remaining 20%. We've committed to $2.5 billion of LNG carriers acquisitions, 50% of $1.4 billion on very large ethane carriers with AW Shipping, 50% of $250 to $500 million on very large ammonia carriers. And on top of that, several $100 million already invested and coming in the integrated logistics business, plus much more to grow on integrated logistics going forward. So we're very comfortable that we'll be able to deploy our balance sheet capacity profitably for shareholders.
And yet the Red Sea shipping attacks are still taking place. According to our own numbers, June was possibly the highest number of attacks for the year for ships passing through the Red Sea. Do you think that the industry has fully adapted now to just the ongoing situation with these shipping routes, or is there more that needs to be done?
I think very close to fully adapted. I mean, the industry is very good at reacting to these circumstances. We've seen them before. Of course, we all hope that the situation will resolve relatively quickly. But essentially what it's doing is taking supply out of the market of ships by forcing ships to travel further around the Cape of Good Hope. And so as a result of that, we see tightness in pricing across shipping segments, but also in general across the industry, we see ships avoiding that region as long as that conflict persists.
How much of a challenge do you think it has been, though, for the industry? And has the industry as a whole had to account for the possibility of not just one-off higher costs, but structurally higher costs?
There's a lot of work in the background, absolutely. I mean, it's something that's coming up multiple times every single day for us, decisions and considerations around how vessels will travel, whether that channel will be open, the impact on availability of vessels for next cargoes and so on. So there is a lot of work in the background. We have to make sure that our crew feel safe and comfortable, that they understand what logistics are going to apply to them. We've changed the pay structures in some cases to account for the impact of the danger in the Red Sea. So there is a lot of impact. But again, the industry is very, very resilient to these types of situations because we've dealt with them before over hundreds of years.
And another sort of balance sheet question here. In the past, you've talked about increasing leverage, and I guess that's part and parcel of some of your expansion plans. How do you plan on doing that? Should we expect you to be issuing more debt?
Absolutely. So we essentially have negative net debt at the moment. We have more cash than we have debt outstanding. We have tremendous financial capacity. We delivered $533 million of free cash in the first half of this year. So we have strong cash flow after dividends, strong debt capacity. But the investments that I talked about before, I named close to $4 billion of investments. And on top of those, we'll have at least a couple of $1 billion already committed or coming in the near term. So those will be financed through that free cash flow and debt. So we intend to use that debt capacity on our balance sheet to grow to the benefit of shareholders. And that's what we positioned ourselves for on IPO, with essentially a clean balance sheet from day one for exactly this reason.
Excellent. Nicholas, always good to talk to you. Nicholas Gleeson, Adnoc LNS CFO. Thank you. Now for a look at some other stories we're following. Disney is forecasting a mid-single-digit profit decline in the fourth quarter. The company reported mixed third quarter results, with weakness at its theme parks offsetting its first ever profit in streaming. Disney sees pressure on park attendance lingering for the next few quarters after previously predicting a rebound in the final months of 2024.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
And coming up, international airlines take stock of unrest in the Middle East. We'll look at how flights are being impacted as the world watches tensions between Iran and Israel next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, in Dubai, residents may be able to fly across the city via air taxis as soon as next year. Well, a quicker way to get to work. During an earnings call, the Joby Aviation CEO told analysts that the startup is targeting a commercial launch late next year. The electric aviation startup is one of several manufacturers designing aircraft to fly customers on short commuter journeys. I definitely put my hand up for that one. Now, elsewhere, some airlines are suspending flights to the Middle East as anxiety rises over the possible strike by Iran on Israel. A growing list of international airlines are exercising caution as they cancel commercial flights to various cities, including to Tel Aviv and Tehran. So for more on this, joining me now is our Mideast aviation reporter, Leila Al-Rashdan. Leila, it's good to have you with us. Just give us the latest. What do we know about airlines canceling flights into the region?
So a lot of American airlines, a lot of European carriers have halted flights to Tel Aviv. You have Delta, Ryanair, EasyJet, and you have Deutsche Lufthansa and its subsidiaries not flying to Tel Aviv, Tehran or Beirut. We've also seen overnight Egypt stops flights or overflights to Iran for about 3 hours because of military training. And then the UK and Canada have issued similar advice to their carriers to not fly over Beirut.
Is there a distinction with the airlines in terms of how the international airlines view the risk in the region versus some of the more domestic airlines?
Yeah, the Middle East carriers are still flying to these countries. They're still flying to Beirut, still overflying Iran. It seems the European and American carriers are more worried about escalating tensions.
Yeah. And when you're an airline making a decision like this, what are the factors that you're taking into consideration? what are they thinking of in announcing that they're suspending flights or delaying flights?
Well, of course, the escalating tensions, any possible airstrike. But then even if an airspace closure happens before an airstrike, there's disruptions to flights, there's worries from crew members, and of course you don't want to leave passengers stranded. And for Middle East carriers, some of them, like Middle East Airlines, the Lebanese national carrier, they're worried about insurance.
Yeah.
So they've parked some of their planes outside the country.
Yeah, they're not even in the country, and that's a very good factor. Insurers obviously playing a big role here. Leon, thank you for giving us an overview on the travel situation into the Middle East. A quick look at futures before we head out. And of course, we've been sitting waiting for this response. The retaliation has not responded, so it is quiet on the Middle Eastern front. But equity markets have been quite volatile in the overnight session, dipping between positive and negative. As you can see now, S&P futures are tilted toward the red. They were positive a short while ago. Nasdaq mildly green. As we head into the European session, however, Eurostoxx futures seen opening 1% lower. So it looks like it might be another day of red for these European assets. But that was our show today, Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.